Okay, hello class, how are you? We're going to talk about chapter 5 today, receivables and sales. And these are some of the topics we're going to cover. If you see right in the textbook, part A, recognizing accounts receivable, we're going to cover these. Part B, estimating uncollectible accounts, we're going to cover these. And notes receivable, we're going to cover this one topic. So let's dive right in. Okay. Now, you know something about accounts receivable from prior chapters. When you do something for a customer, you provide a service or you sell a product, and your arrangement with the customer is that they will pay you later. As soon as you provided the service, as soon as you delivered the goods, you have revenue, right? You have revenue. So if the customer were to pay you at that time, you would debit cash and credit revenue. But if the customer doesn't pay you then, your arrangement with the customer is that they pay you later, that's debit accounts receivable and credit revenue. Right? So we don't have to just wait until we get cash to record revenue. We record revenue when the service is provided. For example, look at this entry, March 1st. A company provides services to a customer. The customer doesn't pay at the time of service, but instead promises to pay by the end of the month or within 30 days, right? This took place on March 1st. 30 days, that's the usual arrangement. Debit accounts receivable, credit service revenue on March 1st. Then on March 31st, when the customer pays, debit cash, credit accounts receivable. So when is revenue recorded? Revenue is recorded at the time the service is provided. If this was merchandise, the time the merchandise is delivered. All right, debit accounts receivable, credit service revenue. When the customer pays, debit cash, credit accounts receivable. Right, notice the payment date was March 31st. Our arrangement with the customer, we allowed the customer 30 days to pay. But we've known that. Okay, now they talk down here about other types of receivables. Anytime anybody owes you money, it's a receivable. If it was a customer in the context of you providing services or selling merchandise, those are what are called accounts receivable. Sometimes for unusual transactions, we can use notes receivable instead of accounts receivable. But if the notes receivable came about because of a revenue transaction, those are called trade receivables. Any other type of receivable you have is called a non-trade receivable. For example, a tax refund. That's a non-trade receivable. Loans, if the company loaned money to a stockholder or an employee, right, the interest on that loan would be receivable. But don't worry about that because we're not going to really see that. So net revenue. When you see the word net, it means we're going to take a gross number and then subtract something from it. So gross revenue is the big number and net revenue is a smaller number. Just like your paycheck, your gross pay, right, is what you earned for the week, but your net pay is a lower number because a lot of different things were subtracted from your paycheck. So here, similar, gross revenue is the big number, and then net revenue, we subtract these items. Now notice they list 4 items here: trade discounts, sales returns, sales allowances, sales discounts. What's a trade discount? Well, a trade discount represents an amount we take off a list price. So let's say you went to the car dealer, and the car dealer, that you look at the car you like, it's sitting there, it's beautiful, it's shiny, you fall in love with it, you want to just take it and drive it home. The sticker price is $30,000. Right? But the dealer says, we'll let you have it for $27,000. That would be a $3,000 trade discount. It's something that comes off a list price. We don't have to make a journal entry for a trade discount. So they give you an example here. This is kind of a creepy example. It's a doctor that provides eye surgery, right? And the cost of the surgery is $3,000, but for you, just for you today, I'm only going to charge you $2,400 for that surgery, right? There was a 20% or a $600 trade discount. Debit accounts receivable, credit service revenue. So we don't make any kind of journal entry for the trade discount. We'll see later when we're talking about sales discount, we do make a journal entry for that. But for trade discounts, no, it's just a reduction in the selling price. One would argue it's just BS, right? That the real cost of the service was $2,400, and that's what they were going to charge you anyway. Now, sales returns and sales allowances, real quick. When you sell merchandise, how many times have you bought something or you got something as a gift maybe, and you didn't like it, wrong size, wrong color, maybe it was damaged? You returned it. Okay, that's a sales return. What's a sales allowance? A sales allowance is you get to keep whatever it is, and the person that sold it to you will take some money off. Right? And we'll see the example in the text, which again, it's part of this creepy eye doctor example. But here's an example of sales returns. So the eye doctor, in addition to doing surgery, he also sells glasses. So on March 2nd, the doctor sold sunglasses to one of its customers, $200 on account. What entry? Debit accounts receivable and credit sales revenue. Now let's go back and look at this one. This was the eye surgery. Debit accounts receivable, credit service revenue, right? So when you have a service, you credit service revenue. When you sell a product, you credit sales revenue, right? So just something to be aware of. Debit accounts receivable, credit sales revenue. Now, 2 days later, the customer decides she doesn't like the glasses and returns them. So what entry would the eye doctor make when the customer returned the glasses? Debit sales returns, credit accounts receivable. All right, debit sales returns, credit accounts receivable. It's like the transaction never took place. But just be aware, right? Sales revenue is a revenue account, and except for closing entries, remember closing entries, chapter 3? Except for closing entries, we never debit revenue accounts. Never, ever, ever, ever debit revenue accounts. So this sales returns kind of takes the place of that. It takes the place of debiting sales revenue. So this account, sales returns, is a contra revenue account. Remember contra? Remember accounts, accumulated depreciation? Contra asset account, right? An asset account with a credit balance. So sales returns, a revenue account with a debit balance. Contra revenue account. Okay, sales allowance. Now remember, with sales allowance, the customer gets to keep what you sold them, but you lower the price. So in the case of merchandise, let's say those sunglasses, right? Say this sunglass example here. What if the doctor said, well, why don't you keep the glasses? I'll take $50 off. Right? In a case like that, the doctor would have debited sales allowances and credited accounts receivable for $50. Right? Here, this was a complete wipeout of the original sale. Right? Now, here's an example of sales allowance with the surgery. Right? Now, if you read this thing, and again, this is why this example just kind of gets to me, because I don't think I could ever see anything like this happen in real life, but it looks to me like the customer that had the eye surgery went back there and wasn't happy with the surgery. Well, how can a doctor take back surgery? Right? I mean, once it's done, it's done. So what the doctor did here was to say, oh, okay, I realize you're not happy. I'll lower the price. I'll lower the price by $400. Debit sales allowances and credit accounts receivable. And sales allowance is another example of a contra revenue account. Okay, sales discount. Sales discount. When we sell something to somebody on account, right, normally we give them 30 days to pay. That's pretty standard. And, 30 days, when you think about it, when someone owes you money, that's a long time. Because you have bills to pay. And you would love to get paid sooner than 30 days, right? But you want to give your customer time because your customer has to go out and do what they have to do to get paid from their customers. But why not try to sweeten the pot a little bit? In other words, go to the customer and say, listen, you have 30 days to pay. However, if you can pay me sooner, let's say like within 10 days, I'm going to let you save some money. Now, again, it may not be a tremendous amount of money, 1%, 2%, 3%, right? But everything, things add up. So your customer might want to take advantage of that. Now, how is that shown? You'll see it here, 2, 10, and 30. 2, 10, and 30. It's a way of saying, if you pay me within 10 days, you can save 2%. Otherwise, you've got to pay me the full amount within 30 days. All right, now let's go back to the doctor example. Right? Let's go back to the beginning. The doctor does the eye surgery. Debit accounts receivable, credit service revenue. Right? Remember that? A few days later, the patient realized the surgery didn't work. Patient's bumping into walls. Doctor decides, okay, I'm going to lower the price. So on March 5th, the doctor debits sales allowances and credits accounts receivable. If the patient can pay by March 10th, the patient can take 2% off the amount owed. What was the amount owed? Well, it was $2,400 minus the $400 allowance. It's $2,000 now. $2,000 times 2% is $40. That's the amount at a discount. So the patient only has to pay the doctor $1,960 instead of $2,000. Patient gets to save $40. So what does this look like in terms of a journal entry? Debit cash, $1,960. That's the amount of cash the doctor received. Debit sales discounts, $40. That's 2% off 2,000. Credit accounts receivable for the full amount, 2,000. This sales discount account is another example of a contra revenue account. Contra revenue. So what does this all look like on the income statement? You've got service revenue was $2,400. Sales revenue was $200. Those were the glasses, right? The service revenue was the surgery. The sales revenue were the eyeglasses. Less, subtract. The glasses were returned. There's the 200. Sales allowance, 400. Remember, the customer wasn't happy with the surgery. Sales discount, that's the $40 the customer saved by paying within 10 days. So what's the net revenue? $1,960, right? And that's what would go on the income statement. Again, that's only one transaction, but you get an idea of what that would look like on the income statement. Here's the T account for accounts receivable. Here's the eye surgery, $2,400. Here's the sale of the glasses, $200. Here's the glasses being returned, $200. Here's the sales allowance for the patient that didn't like the surgery, $400. And when the customer pays in full, there's the $2,000. So how much does the customer owe at the end? $0. If the customer paid after March 10th, right, after March 10th, the customer would not be entitled to the discount. The customer would have to pay the full amount, in which case you would debit cash and credit accounts receivable for the full amount. Okay. New topic. Tough topic. This, for some reason, right, I've been teaching accounting for a very long time, and this is one of the topics that for some reason gives students a lot of trouble. I have my own theory as to why. I will share it with you at the appropriate time so that maybe you don't fall into the same trap. But we have to estimate, again, the question is, what happens to people that don't pay, right? And that might have been one of the things you were thinking about since we started a few weeks ago. Right? We talk about accounts receivable like it's a guarantee. It's not a guarantee. But if you do your homework, if you only extend credit to people that deserve the credit, chances are, most of the time, you'll get paid. But sometimes you won't. It's nothing to get upset about. It's nothing to take personally. It's another cost of doing business. Just like paying rent is a cost of doing business. Just like paying taxes is a cost of doing business, right? Just like paying salaries to your employees. You think they're working every minute of every day? No, of course they're not. Right? It's just another cost of doing business. You expect, if you extend credit to enough people, there are going to be some that don't pay. And, you know, when you think about this, you think about people that deliberately tried to take advantage of you. That's not usually what happens. Usually what happens is some strange or unusual or unforeseen circumstances happen. COVID, for example, COVID. Who ever thought we would be living like this? Who thought this? Go back to January, February, right? We went about our business. We did the same things we did every day. Then March, I think it was March 9th, school shut down, right? And shortly thereafter, a lot of other things shut down. And a lot of us have been living in seclusion pretty much since March. How many businesses you think were negatively affected by this? Thousands, millions, right? No one ever thought something like this would happen. So if you had a business and somebody owed you money, go back to January, go back to February, chances are they didn't pay you. Totally unforeseen circumstance. Other unforeseen circumstances. Bankruptcy, right? You and I, we could have been doing business together for 5 years, 10 years, 20 years. All of a sudden, my business turns. I may have had the greatest business. Look at businesses like Blockbuster. Remember Blockbuster? You used to go in there to rent a tape, right? To watch on your VCR. And then what happened? Netflix came along. Blockbuster died. So a lot of times these things happen. They're totally unforeseen. They're not planned. And they didn't happen for someone to take advantage of somebody else. That just happens. So people go bankrupt. People get sick. People get divorced. I mean, they go through all these kinds of things in their lives that makes them unable to pay you. It's not personal. It's just one of those things that happen. And if you deal with enough people, I guarantee you, some of those people will have some of these things happen to them, and you won't get paid. Okay. Now, remember what this started out with. Estimating uncollectible accounts. We are going to use what's called an allowance account to do this. Allowance method gap. In other words, this method is generally accepted accounting principles. It takes into consideration that expense recognition principle that we talked about in chapter 3, I think it was. The allowance account is a contra asset account. Just like accumulated depreciation, right? You had the equipment account, and then you had the accumulated depreciation account, and you subtracted that from the equipment account to get the book value. We're going to do something similar with accounts receivable. We're going to take the accounts receivable and we're going to subtract the allowance account to get something called the net realizable value. So how do we establish an allowance account? We have to estimate what we don't think we're going to get. No names, no specific people. We're just looking at the big picture, right? So if we look at this example, right? If you read the example here in the book, this is a medical clinic. And at the end of the year, their patients, customers, owed $20 million. $20 million. The company estimates that 30% of that will not be collected. So what's 30% of 20 million? It's 6 million. So out of that 20 million, we don't think we'll get 6. How much do we think we'll get? 14, right? 20 million minus 6 is 14. What journal entry do we make? Debit, look at the date, December 31st. What entries do we make on December 31st? We make adjusting entries, don't we? This is another one of those adjusting entries that we learned in chapter 3. Debit bad debt expense, credit allowance for uncollectible accounts. 6 million. Now, this is the key. What I'm telling you now is the key. You have to understand this account. If you can understand this allowance for doubtful accounts, when do you debit it? When do you credit it? Right? That's the key to understanding this. The bad debt expense is really not important. The number that goes in the bad debt expense follows whatever you were going to put in the allowance. So really, when you're calculating 20 million times 30% is 6 million, you're calculating the balance in the allowance account, right? You're calculating the balance that's in the allowance account. So the debit to bad debt expense is whatever that number is. You're calculating the number that goes into the allowance account. Something else to keep in mind. The only day of the year you debit bad debts expense is the last day of the year. In this case, December 31st. The only day of the year this account gets debited is December 31st. If you can remember those two things, you got this. All right, so here they're showing you a nice diagram. During the year, again, if you go back and read the example, during the year, they had sales of 50 million. By the end of the year, 20 million is still not collected. 20 million is your accounts receivable. And they said 30% of that, 30% times 20 is 6, will be uncollectible. Well, if 6 is uncollectible, how much is collectible? 14, right? Because these two have to add up to the 20. On the balance sheet, what does it look like? Accounts receivable, 20, less allowance, 6, net, 14. So you see what you're telling everybody? You're telling the readers of the financial statements, the people you're presenting these financial statements to, right? Think of your stockholders, think of your investors, think of your banks or other places where you borrow money from. Look at what you're telling them. Look at the story these numbers say. All my customers together owe me $20 million. If I'm lucky, everybody will pay me, and that's the most I can get. However, I know that that's not going to happen. I know that people get sick, people get divorced, horrible things happen to people, people get COVID, right? People get into car accidents. All these horrible things happen to people that will prevent them from paying me. It really is out of my control. I can't control those things that happen. It's my experience that I won't get 6 out of the 20. How much will I get? 14. I think I'll get 14. I could get a little more. I could get a little less. So before you decide to invest your money with me or to lend money with me, you need to be aware of that. I'm not going to get the 20. I'm comfortable with getting 14. I might get 15, right? I might get 13. My best estimate today is 14. Another thing, this 6 million, what does that really mean? That is my best estimate of what I won't collect on this day, December 31st. It's my best estimate of what I don't think I'm going to collect. In fact, this account in general Anytime you look at it, anytime you look at the balance in that account, it represents the estimate of what you don't think you're going to collect that day. Now we're going to see that that balance can change. Writing off an accounts receivable. Now, what does that mean? When you write off an accounts receivable, it means you've given up on collecting it. Now, you don't give up right away, right? You don't give up right away, as a rule. In other words, if somebody owes you money, you do everything you can to collect it, right? You make phone calls, you send out letters, you might go to your bank and say, could you see if you can collect it from them? You might go to your lawyer and say, could you please write a threatening letter to get them to pay, etc. This could take months, months. So it's not like, somebody owes you money today and tomorrow you say, oh, they don't owe it anymore, I'm going to give up. You could wait months. Now, again, every company has different policies on things like this. I would say anywhere from 4 to 6 months. If you haven't gotten paid, you're not getting paid. It's time to write off the account. Right? Write off the account. Now, a lot of stuff. So here's an example here. Here's a customer, Bruce something, right? Bruce declares bankruptcy. I think that's what happened here. So now it's time to give up on Bruce, because once somebody declares bankruptcy, you are not getting paid. Okay? So what are we going to do? We're going to write off the account. Now, a lot of you might be tempted to debit bad debts expense, right? Because that would make a lot of sense. Debit bad debts expense. However, bad debts expense, you only debit what day? December 31st, right? In this case, this is February 23rd. So you can't debit bad debts expense. You have to debit something else. The account that you debit is allowance for uncollectible accounts. Debit allowance for uncollectible accounts and credit accounts receivable. You're writing off the account. Notice they say here, common mistake. Students often mistakenly record bad debt expense when they write off an uncollectible account. Remember, the bad debt expense was recorded on December 31st, which was in a prior year. Okay, now, we wrote off Bruce's account. Bruce went bankrupt. We read it in the newspaper. Right, we gave up. 7 months later, you open your mail and there's a check from Bruce for $1,000 and maybe a note saying that he's sorry. Right, now you'll throw the note away right away, but you'll keep the $1,000 check, won't you? So now what are we going to do? Well, now what we have to do is we have to put Bruce's account back on the records. So remember when we wrote him off? Debit allowance, credit accounts receivable. We're going to reverse that. We're going to put that back, but we only put back what he's able to pay us. So if he was able to pay us the full 4, we would debit accounts receivable and credit allowance for 4. But since he's only paying us 1, we debit accounts receivable and credit allowance for 1. Right? We reestablish the account previously written off. And then we debit cash and credit accounts receivable. Okay. Now notice here what they call this adjusting the allowance account in subsequent years. Go back to the original example. We estimated that $6 million wouldn't be collected, right? If you go back to the beginning of this section, it was $20 million times 30% is $6 million. Our best estimate at that time was $6 million. Now I want to show you something. Here's the T account for allowance for uncollectible accounts. This is the $6 million that we started with. The credit side of this account represents the estimated amounts of what we don't think we'll collect. So remember, we didn't think we were going to get $6 million. That's why that goes here. The debit side of this account represents people like Bruce that we wrote off, remember? So when you look at this allowance for uncollectible accounts, the credit side is the estimate. The debit side is the actual. These are the accounts that actually were written off. This was our estimate. We were off. We were off by $2 million, right? So at the end of that year, what was the balance in the account? It was a credit of $2 million, meaning that our estimate was too high, $2 million. All right, now let's go back and look at this. Now remember, when they estimated $6 million, that was the first year they were in business. They had no history. They were maybe just listening to what somebody told them or what their accountant said to do. Or maybe they belonged to a trade group and the trade group said use 30%. Right? But now that they've been in business for a year, they have a good idea or a better idea. And what they do is they prepare what's called an aging schedule. See this? Aging schedule. And what's an aging schedule? We list all the accounts down. See the names of the people? And how long do they owe us money for? So not yet due really means less than 30 days, right? Because normally we give people 30 days to pay. So any amount that's in this column is less than 30 days old. 1 to 60, 61 to 120, more than 120, right? So we age the accounts. We look at each customer and we say, how long did that person owe me the money? Right now, again, you know, when I first started, I hate to tell you how long ago this was. When I first started in the business world in the 1970s, we used to do this by hand. Yes, by hand. But now all of this is done on the computer, right? So what used to take me days to do, you can get every day. Every morning when you come in, you can run this report. So notice that the total accounts receivable is 30 million, but it's made up of this 16 plus this 9 plus this 4 plus this 1. Now, the longer somebody owes me money, the less likely I am to get paid. So notice for this first group, I'm going to use 10%. I'm saying that of that 16 million, I won't get 10% of that. Of this 9 million, I won't get 30. Of this 4 million, I won't get 50. Of this 1 million, I won't get 70. So if I multiply, I get these numbers along the bottom. And when I add them up, they add up to 7 million. Now, what is that 7 million? What does that 7 million represent? That 7 million represents what I want to see in my allowance for uncollectible accounts. That 7 million is the number that I want to see in the allowance for uncollectible accounts. So if you go down to the account, you want to wind up here at 7. You want to wind up here at 7. Well, where are you now? You're at 2. What number do I have to add to 2 to get to 7? 5. So my adjustment is going to be for 5. By adding 5, I'll get to 7. I want to be at 7. Right now I'm at 2. 2 plus 5 is 7. Debit bad debt expense, credit allowance for uncollectible accounts for 5. Right? And now I'm exactly where I need to be. Accounts receivables, 30 million. The allowance for uncollectible is 7. It's kind of blurry here. My net is 23. And on my income statement, the bad debt expense of 5 will go. Okay. So that's most of what you need to know in chapter 5. And in the next video, we'll get to the homework.